a billion-dollar crypto empire once dominated the digital finance world.
Cryptocurrency markets were expanding at an unprecedented pace.
FTX rapidly expanded its presence across international markets.
Major investors placed billions of dollars into the company.
The brand became visible through massive sponsorship deals worldwide. Millions of users trusted the platform with their investments.
But behind the success, a dangerous question was beginning to emerge. Behind the polished image of success, hidden risks were quietly growing.
The founder was widely praised as a visionary entrepreneur.
Rapid growth masked serious governance failures inside the company.
The company relied heavily on financial arrangements with its sister firm.
Reports surfaced about the misuse of customer funds.
The collapse proved that without transparency and accountability, even the strongest companies can fail. Investors rushed to withdraw their assets as confidence collapsed. In 2019, a former quantitative trader launched a new cryptocurrency exchange.
The platform quickly gained attention for its advanced trading features.
Within a short period, the company expanded globally.
Major venture capital firms invested heavily in the company.
By 2021, the company had become one of the largest cryptocurrency exchanges in the world. The company invested heavily in sports sponsorships and stadium naming rights. This rapid growth created strong public trust and encouraged investors to place their savings on the platform.
The business model of the company focused on providing a digital platform for cryptocurrency trading.
Revenue was generated through transaction fees, margin trading, and financial derivatives.
Cryptocurrency exchanges must protect customer assets and maintain liquidity. The company introduced its own cryptocurrency token called FTT. The value of the token became closely tied to the company's financial health.
As you can see, the emerging markets are driving this growth.
Absolutely, the strategic alignment is paying off.
We are forecasting a 20% increase by next quarter.
The lack of clear separation between the exchange and the trading firm created significant financial risks. One of the primary causes of the collapse was the misuse of customer funds.
Billions of dollars were transferred to support risky trading activities.
This practice violated basic financial principles and undermined customer trust. The relatively unregulated nature of the industry allowed operations without sufficient supervision. When major trading losses occurred, the firm relied heavily on borrowed funds to survive.
Customer assets were exposed to high-risk investments without their knowledge.
Once investors discovered the misuse of funds, confidence collapsed and mass withdrawals began.
Another major factor in the collapse was the absence of strong corporate governance.
Critical financial decisions were controlled by a small group of executives.
There were limited checks and balances to monitor financial transactions.
Reports later revealed that the company failed to maintain proper accounting records.
This lack of transparency made it difficult to understand the company's true financial position. Risk management systems were poorly designed or completely absent. These governance failures created an environment where financial mismanagement could occur without detection. The immediate trigger for the collapse was a sudden liquidity crisis.
News reports raised concerns about financial stability and reliance on internal tokens.
Investors began withdrawing their funds at an unprecedented rate. Within a short period, billions of dollars were withdrawn in a digital bank run. The company did not have enough liquid assets to meet customer demands. Attempts to secure emergency funding from investors and competitors were unsuccessful. The company was forced to suspend withdrawals, confirming the severity of its financial crisis.
The collapse highlighted significant weaknesses in regulatory oversight within the cryptocurrency industry.
Many exchanges operated in jurisdictions with limited regulatory frameworks.
The company expanded rapidly without rigorous financial audits or compliance checks. Regulators struggled to monitor operations due to the global nature of cryptocurrency transactions. The rapid pace of technological innovation made it difficult for policymakers to develop effective regulations in time.
The absence of standardized rules for asset custody, financial reporting, and risk management created opportunities for risky behavior.
The crisis emphasized the urgent need for stronger international cooperation in regulating digital financial markets. Many institutional investors suffered significant financial losses. The event triggered a decline in cryptocurrency prices as confidence weakened.
Several smaller companies relying on FTX were forced to shut down.
The incident damaged the reputation of the cryptocurrency industry. Governments responded by introducing stricter rules and monitoring mechanisms.
The collapse served as a wake-up call for the entire digital finance ecosystem.
Transparency and accountability are essential for maintaining trust in financial institutions.
Companies must ensure that customer funds are protected and financial records remain accurate and accessible.
Strong corporate governance and risk management systems are necessary to prevent financial mismanagement and fraud.
Regulators must develop clear and consistent rules to oversee the evolving cryptocurrency market.
Investors should conduct thorough research before investing and avoid relying solely on marketing claims or celebrity endorsements.
Rapid growth and innovation cannot replace sound financial practices.
By learning from this case study, stakeholders can build a more secure and sustainable financial system in the future.